Welcome to The Explainer. I am absolutely thrilled you're tuning in today because we're rolling up our sleeves to conduct a corporate autopsy on one of the wildest business failures in modern history, Carillion. We're going to dig in and uncover the hidden financial weaknesses that completely destroyed this massive British corporate giant from the inside out. So get ready, because what looks like an untouchable success on the outside can actually be a rapidly ticking time bomb on the inside.
Here is our agenda for today. We're going to cover 1. The illusion of strength. 2. Revenue is not cash. 3. The low margin trap. 4. Debt and governance failures. And 5. Lessons from the collapse. Let's jump right in.
To really wrap your head around this case, you gotta picture the sheer, massive scale of Carillion. We are talking about an absolute behemoth here, with roughly 43,000 employees globally. They managed huge government contracts and massive infrastructure projects across construction, maintenance, and outsourcing services. To anyone looking from the outside, they appear deeply established, incredibly powerful, and literally untouchable.
But that brings us to the ultimate mystery of this whole story. How on earth does a giant like that just suddenly collapse? How does a company with that much visible strength, employing tens of thousands of people, suddenly become one of the UK's largest corporate bankruptcies ever, leaving behind roughly £7 billion in liabilities and completely shocking the business world?
Section 1. The illusion of strength.
Carillion operated in a world where scale was absolutely everything. Their master plan was to expand aggressively by winning huge infrastructure contracts and diversifying across both construction and government outsourcing. And hey, on paper, this looked like a brilliant strategy. More contracts meant more revenue streams. Snagging those high-profile government partnerships built massive market credibility. By diversifying, they created this incredibly convincing appearance of long-term, rock-solid stability.
But here's the catch. The company's downfall wasn't caused by one sudden dramatic explosion. Think of it more like an iceberg. What we're actually looking at is a quiet, super dangerous accumulation of financial weakness, totally hidden beneath that visible growth. You see, in project-based industries, this kind of rapid growth actually creates massive financial risk way down below the waterline, building pressure day after day until something inevitably snaps.
Which brings us to Section 2, revenue is not cash.
This right here is the fatal flaw that doomed Carillion's leadership. You see, accounting profit is all about long-term projections and future assumptions. It looks absolutely amazing on a quarterly report to your shareholders. But available cash, that's immediate liquidity. It's the actual real-world money you need today to pay your suppliers, fund your daily operations, and make payroll. Carillion fatally confused the two. They reported these massive revenues, but their accounting profits were tied up in projects that took years to finish, while cash shortages were creating immediate, daily operational danger.
When you actually map this timeline out, it's wild to see how these massive contracts just bleed cash. On day one, heavy upfront spending begins. You're buying materials, hiring crews, mobilizing resources. Then, months later, unexpected operational costs inevitably start to creep up. But it isn't until years later that the project is finally completed and those delayed payments actually arrive. So for years, the company is completely starved for liquidity, desperately trying to survive day to day while waiting on future cash that they've already aggressively counted as revenue.
All right, Section 3, the low margin trap.
Crazy enough, winning these highly competitive projects is exactly what choked the business. They would bid aggressively low just to undercut their competitors and win the job. But the direct consequence was incredibly low profit margins, like often under 3%. Operating with margins that thin meant they generated almost no cash surplus to act as a buffer. So the moment they experienced even a minor project delay or a tiny spike in material costs, their profitability disappeared rapidly. They were winning billions in contracts, but at margins so razor thin, they literally couldn't afford a single mistake.
When you combine those massive operational commitments with zero financial flexibility, you are in a terrifyingly dangerous position. When you have a huge portfolio of complex projects without an adequate cash buffer, small operational problems don't stay small. They spread like wildfire across the entire organization. And suddenly, that massive scale we talked about earlier, it actually makes oversight and recovery nearly impossible.
Moving right along to Section 4, debt and governance failures.
All of this triggers a vicious four-step cycle. Step 1. Weak cash flow forces the company to intervene. Step 2. They have to increase borrowing just to support basic operations and keep the lights on. But of course, that leads to Step 3. Interest costs and repayment pressures rise, which actually worsens their financial flexibility. And finally, step 4, confidence from lenders and partners starts to weaken, making financing even tighter. Relying on debt to temporarily paper over a fundamental cash shortage doesn't solve the problem at all. It just completely destroys the company's long-term chances of survival.
So this begs a massive governance question. Were these risks clearly communicated, or was leadership just totally blinded by optimism? Why did the leaders of this giant organization focus so heavily on pushing a growth narrative for outside investors rather than openly acknowledging the severe internal financial pressure they were actually under?
Well, what we're looking at is the textbook definition of governance failure. They delayed the tough decisions, they relied on the hope of future improvements instead of actively stepping in to reduce operational risk early on. Look, financial problems do not magically disappear just because you're optimistic. Strong governance means identifying risks before a crisis becomes completely uncontrollable. Because once your cash flow deteriorates past a certain point, recovery simply becomes impossible.
And finally, Section 5, Lessons from the Collapse.
Let's rapid-fire these critical takeaways, because honestly, these are the absolute core of why this whole case matters so much. First, revenue growth is entirely meaningless if you don't have healthy cash flow. Second, if you're in a project-heavy industry, you face massive liquidity risks by default. Third, expanding aggressively can actually magnify your financial fragility. Fourth, taking on low-margin contracts guarantees you are highly vulnerable to operational disruption. Fifth, debt might temporarily mask a crisis, but it fatally worsens your long-term risk. And lastly, strong corporate governance has to catch warning signs early, not just react when the ship is already halfway underwater. Prioritizing growth over cash flow stability is just a guaranteed recipe for disaster.
The big secret here? Scale alone does not guarantee financial stability. Carillion's massive size wasn't a superpower. It was a disguise. The sheer size and complexity of their operations actually served to hide the internal weakness and rot from the outside world for far longer than it ever should have. By the time the crisis was visible to the public, the foundation was already completely destroyed.
So, I'm going to leave you with one final stark question to chew on today. Whether you're studying strategy, managing projects, or running an entire organization, ask yourself, is your business building on a solid foundation of real, liquid cash, or are you just relying on the illusion of revenue? It is a critical distinction, and as Carillion proved, confusing the two can make even a giant disappear surprisingly fast. Thank you so much for joining me for this explainer. Keep asking the hard questions,